Very good morning, everyone. I'm Dr. Neha Dubey, faculty of MBA department in SGI. Today, I'm going to discuss the one of the famous topic of financial management, that is dividend policy. So let's start with the topic. So first of all, we have to know what is dividend policy. A dividend policy can be defined as dividend distribution guidelines provided by the board of directors. But what is dividend actually? So dividend, we can say it's the portion of a profit which company has to be distributed to their shareholders. So the dividend policy can be defined as the dividend distribution guidelines provided by the board of directors of a company. Company's board of directors can decide what can be the amount, what can be the percentage which should be distributed to their shareholders when the company earns profits. It sets the parameter for delivering returns to the equity shareholders on the capital invested by them in the business. So what is why it has to be distributed? Because it shows as are delivering the returns, because the equity shareholders investors invested their money, so we have to return some amount as an interest, as an return, as a reward. While taking such decisions, the company has to maintain a proper balance between its debt and equity composition, because when we are talking about the debt, so we have to pay back their amount or their capital or whatever the company borrowed as a debt. So we have to pay it with a fixed rate of income. But for the equity shareholders, there is a risk is high, because we cannot say that there is a fixed amount. On that basis, we have to distribute the dividend to their shareholders. So here are the content of the PPTs. What is dividend, the factors, types, and essential importance we can discuss in our further lectures. So what is dividend? A dividend is nothing but the return declared to the equity shareholders through the distribution of a portion of profit earned by the organizations. Factors which are affected the dividend policy. So many a time we wonder how a company frames its dividend policy. These dividend decisions of an organization are dependent on the certain following determinants. So here are the chart which shows that these are the factors. On that basis, the dividend policies can be designed, or these are the things which affect the dividend policy. So one by one, we can discuss it in a detail. The first one is the fund's liquidity. It should be framed in consideration of retaining adequate working capital and surplus fund for the uninterrupted business functioning. So funds liquidity, every business has to be maintain the liquidity for the working operation of that company. So on that basis, funds liquidity basis, it can be framed such as the retained adequate working capital. The company has to retain that, and the surplus fund they can distribute, or whatever the decision the board of directors can take, but the funds liquidity is one of the factor which affect the dividend policy decisions. Now the past dividend rates. At the time of deciding the dividend policy, the company's organizers or the board of director has to go through the past dividend rates also. So there should be the steady rate of a return on dividend to maintain the stability. Therefore, the previous year's allowed return is given due consideration. Why it is necessary? Because to maintain the stability or steadiness. Because if in a 1 year the company distributed the lump sum amount of a dividend, and in a next year, due to the less profit earned by the company, they distributed the very less amount. So it will fluctuated vastly the rate on that basis the dividend distributed. So it will affect the image of company. That's why the past dividend rates helps to decide the dividend distribution. Now the earning stability. When the earnings of the company are stable and show the profitability, the company should provide the dividend accordingly. It is depends on the earnings, means the company earns the more profit, so they has to be, or they show some interest to distribute the dividend, or they can store for their purpose also, that is the retained earnings. So earning stability, when it earns stability wise or the profitability earned in a proper manner, so the company should distribute it as per their accordance. Now the debt obligation, the organization which has leveraged funds through debt need to pay interest on the borrowed funds. Okay, that is the fix. Therefore, the such companies cannot pay a fair dividend to its shareholder, because the first priority of the company to pay back their borrowed funds to their the persons or the debtors from where we can take it in our company. Okay, so they has to be clear first, so they have to be pay interest also. So the limited amount can be remain for distribution of the shareholders. So how much the debt obligation is there on the company, and that will also affect the decision of the dividend policy. Now the investment opportunities. One of the significant factors of dividend policy decision making is determining the future investment needs and maintaining sufficient surplus funds for any further project. If the company already planned to expand their business or invest in a certain place or the certain projects in a future, means they have already the future options for investment. So what they have to do, they have to focus on the retained earning rather than the maximum distribution of a dividend to their shareholders. Now the control policy. When the company does not want to increase the shareholders' control over the organization, it tries to portray the investment to be unattractive by giving out the future dividends. Means if company do not wanted to share the controlling power with the shareholders, so they offer the unattractive things in the form of the future dividends to their shareholders. Now the shareholders' expectations. The investment objectives and the intention of shareholders determine their dividend expectations. Some shareholders consider dividend as a regular income, while the other seeks for the capital gain or the value appraisals. So what is the shareholders' expectations? The company need to know, because the shareholders invested with the some purpose, whether they wanted to the regular income, fixed income, or whether they wanted to be lump sum amount or the capital gain. Okay, or whether they wanted to hold the shareholders power in that company. And the nature and the size of the organization. Huge entities have a high capital requirement for expansion, diversification, or other projects. Also, some businesses may require enormous fund for working capital, and other entities require the same for fixed assets. So all this impacts the dividend policy of the company. What impact? The nature or the size of organization. Now the company's financial policy. If the company's financial policy is to raise funds through equity, it will pay higher dividends. On the contrary, if it functions more on the leveraged funds, the dividend payout will always be minimal. Impact of the trade cycle. During the inflation or when the organization lacks adequate funds for business expansion, the company is unable to provide handsome dividend. That is the trade cycle, means during inflation period for the organizations is lacking the adequate fund for the business expansion. So of course they are not ready to pay the dividend because they are suffering from the lacking of funds. Now the borrowing ability. The companies with the high goodwill has excellent credibility in the capital as well as the financial markets. So with a better borrowing capability, the organization can give decent dividend to the shareholders. Now the legal restriction. In India, the Companies Act 1956 legally abide the organizations to pay dividends to the shareholders, thus resulting in a higher goodwill. So legal restrictions are there. corporate taxation policy. If the organization has to pay substantial corporate tax or the dividend tax, it would be left with a little profit to pay out as a dividend. Because if organizations have to pay the lump sum tax to the in the form of the dividend, in the form of the corporate, so definitely with the out of the profit earned by the company, the minimum amount has to be stored for their future investment also. So very less amount left for the distribution of a dividend. Now the government policy, if the government intervenes a particular industry and restrict the issue of shares or the debentures, the company's growth and dividend policy also gets affected. Means government interventions is there. And the divisible profit, the last but a crucial factor is the company's profitability itself. If the organization fails to generate enough profit, it won't be able to give out decent dividend to the shareholder. It is a very common thing. If the company do not earn the proper profit, so how they will distribute to the dividend to their shareholders, because there is a lacking of the funds. Okay, so this is all about the factors of a dividend policy which impact while making the dividend decisions. So in a next lecture, we will continue the types of dividend policy. Thank you.